Hello and welcome to the Small Business Briefing. I'm Brian Calley, the CEO of the Small Business Association of Michigan.
Good afternoon. I'm Sarah Miller, Vice President of Marketing and Strategic Communications for SBAM. Thanks for joining us today. I want to say welcome to one of our new VIP members, Spectrum Food, located in Wixom. So welcome Tim Sunder and team. And we are able to welcome our new member on behalf of our sponsor, Consumers Credit Union. You can learn more about Consumers Credit Union at consumerscu.org. Okay, let's dive into today's topics. First up is Line 5. The Line 5 permit has been delayed. So Brian, can you talk a little bit about what this means moving forward?
Yeah, this is kind of a disappointing surprise in that there's a permit from the Army Corps of Engineers, which is required to go to burrow the tunnel between the Straits of Mackinac, because it is a shipping lane that falls under the jurisdiction in part of the Army Corps of Engineers. There was a time when some of the state permits looked like they might be delayed, but then they weren't. They were issued, and this is the last one before construction can start. There was a public comment period, and the Army Corps of Engineers just was going through the process, and they were expected to issue to essentially start right away the review process of the permit and the final stretch. And under the new timeline, their report on the environmental impacts of the tunnel project will not be issued now, they're saying, until spring of 2025, and then an approval decision in terms of issuing the permit wouldn't be until early 2026. So it's a very substantial delay, about 18 months later, pushed out later than what was expected. This is a very complicated process, and there was a reason why there was an expectation that this permit would be issued earlier. It's because the work on the environmental impact of the tunnel has already been done. What they're extending it for now is, like, in some cases they'll need to build temporary roads to bring in equipment, and so what they're saying is just the bringing in equipment, they didn't study the environmental impact of those sorts of things. So things that are very ancillary to the main project and would be temporary in nature, it's quite a delay for something like that. So it's difficult to say from the outside if it's more political capitulation or if it's just they have other projects, and the fact that they weren't ready to move on it right now means it got pushed way off into the future. In the past, the Army Corps of Engineers process has not been politicized, and so that's why I was a little bit surprised. They're usually very professional, very predictable, and not to say easy. They're very difficult to deal with, but the idea that there would be an 18-month delay this late in the process after the state had done its part was kind of a surprise. What's at stake, though, is permanent replacement of this line. It's not one it's really feasible or possible to live without. You couldn't ship by truck. You see now with rails aren't as safe as apparently as what maybe people thought before. So there is no realistic alternative. Sooner or later, this project will happen. And from those of us in Michigan, would rather eliminate the risk of something happening with the existing pipeline by putting it in a dry tunnel 100 feet in bedrock below the bottomlands of the straits. So a project that makes a lot of sense, but looks like we're going to have a years-long wait before the pipeline, which now just lays along the lake bed, can be put into a tunnel and bedrock below.
All right, next up on our list of topics today is unemployment and labor force. So the state's unemployment and labor force updates came out last week. And were there any big changes from previous months?
Pretty straightforward report. No, not really changes in terms of the percentages. The unemployment rate stayed at 4.3. So Michigan's unemployment rate is 4.3%. That is the same as it was in the previous month. And comparing it to the national, we've covered this on Data Monday before. The national unemployment rate is 3.6. And then labor force participation, you might recall it had actually crept a little above 60% and then fell below at 59.8. So that stayed the same from the previous month. Then if you compare it to let's see, Michigan's unemployment from February 23, it remained below the 2020 pre-pandemic level. Labor force participation rate right before the pandemic began was 61.3. So haven't caught up. It just really seems to be stalled out at that 59, high 59.8, and crested over 60 just briefly last summer, and just stalled. So something will have to change for it to move any higher than what it is. So while it hasn't changed, I would say generally disappointing, because there's been a lot of effort and work toward doing things to remove barriers, people going back to work, and so far though it's stuck.
Okay, let's talk about another set of numbers. The Michigan Retailers Association produces a sales index month by month, and they just updated the numbers for February. So how did those numbers look?
Yeah, February, you don't really think of it as a high retail month, although the index did rise somewhat, 59.7 compared to 53.8 in January. So anything above 50 is growing. Anything below 50 is shrinking. That's the way that their index works. So sales index was up. And in terms of, now, of course, not for everybody. When the survey that shows, how many are going up and how many retailers are going down in terms of their reported sales, half, so 50% reported sales increases, 40% reported decreases, and 10% reported no change. So I would call it also kind of like the unemployment and the labor force participation rate numbers, while generally or a little bit on the positive side, also came across as a very status quo type of a report on the retail for February.
All right, let's talk about a story that we covered last week, which is the whole banking industry. It was recently reported that Silicon Valley Bank has been purchased, and there's been a lot of jitters in the market. So what does this mean? What does this deal mean for the industry as a whole now?
Yes, First Citizens Bank purchased Silicon Valley Bank. So Silicon Valley Bank is the first one that went under because of the liquidity pressures that we talked about previously. So First Citizens Bank essentially assumed the deposits in the assets. So they're not buying the shares of the bank. They're buying the assets and taking on the deposits, which are liabilities in banking world. And that I think it actually will do something to bolster some confidence that the fundamentals, even of Silicon Valley Bank, were worthy of another bank wanting to come in and assume them. Had they not found anybody, I think it would have sent a message out there, right, that maybe there was a deeper problem than just liquidity. So I think generally positive. Citizens is a pretty old bank. I think in the late 1800s was when it was first founded, about 219 billion in assets. And I actually wasn't familiar with this bank. It was located in Raleigh, North Carolina, but they operate in 23 states across the country, 550 branches going from coast to coast. So West Coast is not a totally new market for them. And so I would say overall, somewhat of a a relief that I'll say a buyer, but an assumer was found for Silicon Valley Bank. FDIC, by the way, put out just a number in terms of insurance. So people that had uninsured deposits at that bank and that the FDIC made good on, it was about $20 billion that FDIC's costs with respect to Silicon Valley Bank. So FDIC essentially works like an insurance company, and so those would be like insurance payouts, if you will. $20 billion. Given the size of Silicon Valley Bank, well, that's, obviously it's a lot of money to pay out. Could have been a lot worse.
All right, moving on to union updates. The United Auto Workers elected new leadership, and there was a close election, and it was also a historic election. Can you tell us why and what implications we might expect?
Yeah, there's Sean Fain beat Ray Curry for the new leader of the UAW. UAW has been troubled in recent years with corruption. A few of their recent leaders that found themselves in prison because of that corruption. But this was the first election where it was the rank and file members of the union that, in a direct way, voted for and elected a new leader. So Fain beat Curry just by a very small margin, 483 votes overall. That was 50.2% to 49.8%. So over the weekend, the winner was declared just in time for today for a conference to kick off the collective bargaining for the United Auto Workers moving forward. I must say, though, that the tenor or the tone of the campaign is pretty aggressive, and it would be reasonable to assume that that between labor laws changing here in the state, new leadership in the United Auto Workers, promising more confrontation with management in the auto companies, for Stellantis and Ford and General Motors as these contracts come up, more talk of exercising the tool of strikes, and just generally negotiating from a much tougher position. I think that we'll probably will see here in Michigan, where we have a pretty big vested interest in what happens in the automotive industry for our overall economic picture. That it's going to look more confrontational and more unpredictable than what we've had in recent years.
You mentioned confrontation and negotiation, and we're seeing a little bit of that right now. One example is U of M grad students who are unionized. Do you want to share a little bit about that story?
Yeah, grad students, some grad students actually teach undergraduate students. So these would be teachers, essentially, that are grad students at the University of Michigan. And they're poised right now to strike over wages and benefits. And just to give you an idea of of the type of scope or context here, the demand is a 60% increase. The university is only, going to put in quotes, only offering 11.5% increases. So that's the showdown or the confrontation. And I think it is in the fact that striking over not getting more like a 60% increase is, I think it's just a little picture that I think there's going to be a lot of labor management confrontation in Michigan, and with the political system changes recently, I think there'll be unions will be more emboldened. And over the next year, time will tell. I'd love to be wrong about this, but I think that this is just the tip of the iceberg of the type of changes that we're going to see in the future. And remember that wage inflation, so the increase in wages, is the main thing that is driving inflation right now. The overall inflation. We've talked a lot about inflation lately, and the problem is that if you just try to raise wages without raising productivity, it means that you get higher costs of everything. And then higher costs means that people demand higher wages, and see how you just get this cycle that happens. And that's the cycle that we largely find ourselves in right now, that the Federal Reserve is trying so hard to dig out of. And I think in Michigan may end up being a place where that confrontation plays out in a way that is pretty blunt and pretty it'll unfold right before our eyes and with the front row seat.
Let's go back to automotive talk. We've covered a lot of the Ford deals that have been happening. And so Michigan is really putting more eggs in that automotive basket. And there's a transition happening between combustible engines and electric vehicles. And so Ford's unique. It breaks out the electric business from the rest. And so what does that tell us about the future of the industry here in Michigan?
It was really an interesting Axios article that featured this breakout. So Ford's financials breaks out the electric vehicle financial performance compared to overall. And I saw one reporter describe it that combustible engines are financing their own funeral. In other words, combustible engine operations are profitable, electric vehicle operations are not profitable. Other car companies do not report it like Ford does, so we can't see in General Motors, for example, but industry analysts believe that they're pretty similar. Tesla would be one of the few companies that is profitable that makes electric vehicles. Obviously, that's possible. But Ford revealed last Thursday that it expects to lose $3 billion in its electric vehicle division in 2023. And that's despite, it's not a sales problem. So there's early successes for the F-150 Lightning and the Mustang Mach-E electric vehicles. So it's not for lack of demand, but still losing money on those. They expect an overall profit of 9 to 11 billion. So a loss of 3 billion, but overall profit 9 to 11 billion. So it shows you that they're still very profitable in the combustible engine market. But as this transition happens, one will start to kind of eat the other one. And so there's in a lot of ways, so sales that would have been in one part of the company will move to another part of the company. And in that part of the company, there will be more and more pressure that they will have to make a profit at it. And so remember, we started this conversation talking about union negotiations and talk of strikes and being more tough in these negotiations. A couple of things are going to happen in the next few years, that as one division, electric vehicle, gets bigger, which requires far fewer components, the combustible engine divisions will get smaller. So there'll be job losses in one area while the other one is expanding, but not one-to-one. There will not require as many people to make electric vehicles as it does combustible engine vehicles. And then also we're already seeing from the major automotive companies that they're kind of top heavy in their in the white collar jobs that they are going to continue to contract in. We're already seeing that happen with recent announcements from the bigger players. So I think this is going to add a lot of dynamics into this process, where there's already kind of a more confrontational atmosphere brewing between labor and management. The industry is going to be transitioning to electric vehicles, but hasn't figured out how to make money at it yet. And so they're going to be downward cost pressures at the time when there's upward pressure on labor costs. All of these things kind of coming to a head. So Michigan has taken the approach in recent years of trying to rebuild a concentration in automotive. While Michigan has done very well in recent years, last 10 years in automotive, it's become relatively smaller in terms of our overall economic picture in the state in the last 20 years. And the economic development efforts have really seemed to be keyed in on putting our eggs back in that basket. And it will come with some risk. It's an industry that already has lots of ups and downs based on economic trends worldwide and across the country that we kind of ride here in Michigan historically more than anybody else. But you add in the pressures of a profitable business being supplanted by one that they haven't figured out how to make a profit in yet, and these opposing labor forces where the automotives are going to be moving toward a model that requires fewer people, and that's something that will likely be another confrontation in the union negotiating process. So all of this, I think, spells some storms brewing on the horizon when it comes to the automotive industry, and some ups and downs, and probably a little bit more unpredictability even than what we've seen in recent years. It's always been lots of ups and downs in that industry, but there's just more factors in play than there have been in quite some time.
You talk about a storm brewing, and we can move to the federal level next, where there is some controversy happening between Congress and the president. So what are those issues and potential ramifications?
Yeah, and this is that debt ceiling issue. You hear it on the news sometimes. There is a ceiling that the federal government can't accumulate any more than a certain amount of debt, and that gets raised each year. And when the budget passes, so the federal government deficit spends every year. Not since the 90s has there been any reduction. You hear it, you might say, hey, but I heard the president say something about we cut the deficit in half. That doesn't mean that the debt has gone down. Doesn't mean that the debt of the government has gone down. It means that the rate at which the federal government is going into debt is smaller. So when the pandemic programs fell off, the deficit spending, the rate at which we're going into debt, got a little bit slower, but is still historically very high. So the last 3 years have been the first, second, and third highest deficit spending years, even, and so it's still very, very high. This debt ceiling issue is going to cause a confrontation because Congress is closely divided, and while on its surface it seems like, well, it makes sense if you got deficit spending at this level, you got to figure out a way to cut it back. But just to give a sense for what that means, I wanted to, pull up you've got military spending, and then accumulated debt, Medicare, Social Security. You add all that stuff together, it's actually about 2/3 of federal government spending. Talk to any Republican or any Democrat practically, they're going to say those items are off limits. That there could be some in military spending. There have been with sequestration and some efforts to reduce spending, but given everything that's happening in the world right now, it's not likely that that's going to be one of the areas that is concentrated on. The largest remaining category would be healthcare. I mean, you got interest on the debt too, and that has to be paid. But then you got social services, and those social services is probably the area where there's going to be some confrontation between Republicans and Democrats in Congress. At the end of the day, they will come to an arrangement, but I don't think that it's going to require bipartisanship. By definition, it's going to require bipartisanship for there to be a final resolution for federal government spending, debt ceiling. From a standpoint of the federal government paying its obligations, it's not really negotiable. It has to happen. And a lot of our financial system is tied to what is considered really a risk-free base. And that risk-free is considered U.S. Treasuries. That's the thing, that's the proxy for risk-free investing. And if the federal government were to ever default, then what that means is that there is no risk-free standard, or Some other government, maybe China, would be the new standard bearer. That it's just the ramifications for that would be so bad. It has to get solved or settled, which tells me it probably will. But the sides look more dug in than they have in previous terms, which I think has made people a little bit uncertain, and how are they ever going to come to an agreement? They won't come to an agreement till the 11th hour. So just go ahead and expect this to go into the summer. Don't know exactly when the federal government will hit its debt ceiling, but it'll probably be like late summer, maybe early fall. And by that point, they'll have to come to some sort of an agreement in order to deal with it. But I would expect a lot of noise between now and then.
All right, I think we have a short Data Monday report today, right?
Yes, I'm going to share with you, toward the end of the month, there's less new data coming out, but I wanted to share a few items that I thought were pretty interesting and worth pointing to. The first is with the banking industry. I just wanted to give an idea of what's happened in the industry over the last 30 years. The red line that you see is showing the total number of banks, and there's been a ton of consolidation in the banking industry. So back in around 1990, 1991, you had over 12,000 banks in the United States. Today, 4,200. So it's a big decline in the number of banks, not the number of assets that banks have. Assets or loans, not the amount of deposits that banks have. It's really a consolidation. The other side of this graph, the bar graph, is showing the number of new charters. And as you can see, there was a lot of fluctuation. And then right around the time of the Great Recession, and the passing of modern banking regulations, the number of new banks fell way off. There are some, look at this, in 2014 and 2016, there were no new banks, no new bank charters. And it had been a long time since that had happened, and a few of those years where there was only one. And while you could argue that there's a slight upward trend since it hit zero, there's not a lot of new bank formation happening out there. And if we had 20 minutes, I'd go through the banking regulatory industry and why this was a very predictable consolidation. Fewer newer banks, older banks consolidating into bigger banks was a very predictable outcome of the banking regulations that came out of the global financial crisis, 2008-9. I zoomed in here so that the legends aren't on here. So let me just show what these are. These dotted lines, 1%, 2%, 3%, 4%, 5%. These are the interest rates, and this is plotting out their interest rates over from the Federal Reserve. So we talk about interest rates going up. That's what this is showing. And down here at the bottom, it's every 5 years. So 2000, 2005, 2010. Each hash is along the bottom is 5 years. And this light blue is where you see recessions. And so this would be the 2002 recession after 9/11, the great global financial crisis in 2008-9, and then the very short pandemic recession in 2020. And right before each of those recessions was where there was concern of interest rate or inflation. You saw interest rates that go up. So interest rates were pretty high before the recession in 2002. They were pretty high, pretty close to what they are right now before the recession in 2008 and 9. And then we're getting to that point now. And between the expected pullback that regulators will require banks to engage in to create or build more liquidity, between that and high interest rates, the idea of adding another recession to this series here that will line up with a rate increase, or a series of rate increases. Really, I think that the market expects this near certainty. It's just a matter of how deep it will be, and so I think a lot of factors are coming together that make the recessionary risk just a lot higher than it even looked just a little while ago. Now, a couple things on real estate. The houses, the price at which houses are being sold at, they definitely have come down. This blue line, you see, has come down. Still, historically, though, very high. Buyers are being very patient. There aren't that many houses on. There aren't as many buyers. Fewer people can afford, higher interest rates. I mean, all these different factors. But at this point, while the prices are coming down some, they're not plunging, and they still could, but at this point they haven't. And so the shortage of houses and people being patient as sellers, it just seems to be holding up. Now, the number of houses, new one family or single family houses, the monthly supply, it had gone up quite a bit until 2023 started, or throughout 2022 with inflation becoming a bigger concern, started to sway back down in terms of the new housing supply. So it seemed like it was on a good clip. We definitely need more housing. Also wanted to, we hadn't looked at the market, the stock market itself. So we've got here the S&P 500, NASDAQ 100, and then the Russell 2000. And while it feels pretty low, and it is compared to their highs, the reason I wanted to show this is that you had this plunge. This red line is the plunge after the early stage of the pandemic. But if you look at where these indexes were, take a look at S&P 500, this blue line, that you look at it where it was right before the pandemic and where it is today, it's actually higher. All three of these indexes are higher than they were right before the pandemic. And so the trajectory, while it did get quite high and then it fell, historically speaking, it actually has recovered some. And so when I look at this, I think the market's waiting for a little bit of this uncertainty to work itself out. But I just thought it was worthy of pointing out that historically speaking, it's actually had this plunge and this surge not happened, and this was just kind of like straight across, it would be kind of a gradual increase. It's just interesting. And then this is just a ratio between bond returns and S&P 500, the stock, generally the American stock market, and really just a slide down. And so even with what this shows is that even with the stock market decline, the ratio with the way the bonds have fallen in value is such that it's really not a good time to hold bonds. There is even today, I watch these things daily, and even today, it seemed like, or at least a few hours ago, there was a little bit of relief, a little bit of calming. But normally, the bond market is very predictable and pretty level. And just lately, it hasn't. It's had a lot of volatility, and I think that's it's why it's so hard to read the signs. So much harder to read the signs than what it has been. But overall, just generally not feeling terribly confident about the direction of things. There's a confluence of worrying factors that I think are conspiring against a strong economy in the next year. And so we'll continue to watch it closely and share as things change. But the good news is the banking industry, I told you before, I thought it looked solid. I still think it looks solid. The overall strength of the American banking system remains such that people ought to have confidence in it. And the fact that the Silicon Valley Bank is found a suitor in a relatively short period of time under a lot of duress, I think is a good sign. As I told you before, I didn't think that bank had asset quality problems that would have warranted a run on it. I think that it was, it could have been okay. That bank could have been okay had it not been for just this kind of panic withdrawal type of a situation. But if you look at overall with the economy, the fact that that happened, even if it wasn't warranted, the fact that it happened, I think there will be a regulatory response. That response will likely result in tighter credit. That, in addition to the higher interest rates, I think that we're going to have a pretty tough economic year here ahead of us.
All right, well, we're kind of ending on a somber note, but we do appreciate you tuning in, and we'll continue to cover these important topics going forward. We'll be back here Thursday at 3 p.m. Have a good week.
Hey, we'll see you on Thursday, everybody.